You know how sometimes a big, familiar company just kind of disappears from the stock market tickers? One day it's right there, a public company you can invest in, and the next, poof, it's gone. Well, that's exactly what just happened to a major player in the mortgage world. So let's get into the story of Guild Mortgage. It really makes you wonder, right? What does that actually mean for a company to vanish like that? It's not about going out of business. Actually, in a lot of cases, it's about getting much, much stronger. And here's the answer. On November 28th, 2025, Guild Holdings, the parent company of Guild Mortgage, was officially acquired. Now, this wasn't just some simple merger. It was a huge move that took the company completely private, yanking it right off the New York Stock Exchange. So let's just take a second to talk about the sheer scale of this move. We are not talking about a small transaction here. This was a massive $1.3 billion deal that completely reshaped the landscape for everyone involved. For shareholders, the magic number was $20. That's the cash price that was paid out for every single share of Guild's Class A stock. And that represented a pretty significant premium over what the stock was trading at, which, made it a very, very compelling offer. Okay, so what does going private actually mean in the real world? Well, it's pretty straightforward. The company's stock gets delisted. That means you can't buy or sell it on a public exchange like the NYSE anymore. And this is crucial, it no longer has to file all those detailed regular reports with the SEC. It's basically a move from the public stage into a private theater. To really understand this story, you've got to know the two main characters in this play. You've got Guild Mortgage and the company that bought it, Bayview Asset Management. They represent two absolutely critical but very different sides of the mortgage industry. So on one side, you have Guild Mortgage, a total giant in mortgage origination. They're the ones who actually create the loans. Then on the other side, you have Bayview, whose subsidiary, Lakeview, is a leading mortgage servicer. They're the ones who manage the loans after they're made. Think of it like this. One company builds the car, and the other one provides all the long-term maintenance for it. And let's be clear, Guild was a giant in its field. As a public company, it was a top 15 U.S. mortgage lender. To put that into perspective, they originated a staggering $5.1 billion in mortgages in just the first quarter of 2025 alone. I mean, this was a major league player. Now, this acquisition didn't just come out of the blue. The relationship between these two companies has actually been building for years. Bayview was already a strong partner and a minority shareholder, seeing as they invested in Guild way back during its IPO in 2020. So this deal was really the culmination of a long-standing partnership. So this is the crucial question, right? Why now? Why make a $1.3 billion move in what everyone knows is a pretty tough market for lenders? Well, the answer lies in a really powerful business strategy, one that's designed to thrive in exactly these kinds of conditions. And that strategy is called vertical integration. It's a fancy term, but the idea is simple. It's when a company takes control of multiple steps in its own supply chain. So instead of relying on a bunch of outside partners for different parts of the process, you just bring it all under one roof. It creates a much more efficient, powerful, and controlled system. So here's what that new integrated ecosystem looks like in practice. Step 1. Guild Mortgage keeps on doing what it does best, originating mortgages all across the country. Step 2. Those loans are then seamlessly serviced by Lakeview. And the final step? Bayview owns the entire end-to-end platform, from the moment a loan is born to its long-term management. And the reason for this vertical integration becomes crystal clear when you just look at the market. We're in a high interest rate environment, and that squeezes the profit margins for lenders big time. This deal is a direct response to that pressure. And honestly, it reflects a broader trend we're seeing everywhere: consolidation among non-bank lenders to build up scale and efficiency. And hey, you don't have to take my word for it. Just listen to Guild CEO Terry Schmidt. She said the move creates one of the strongest and most compelling mortgage origination and servicing ecosystems in the nation. That one quote just perfectly captures the entire strategic vision behind this deal. All right, so the deal is done. The papers are signed. What happens next? For a multi-billion-dollar acquisition, the answer is kind of surprising. For the people inside Guild, it's pretty much business as usual. That leadership team that built Guild into a powerhouse, they're all staying. The well-known Guild brand, it's being kept. And since Lakeview is a servicer and not a retail originator, there's no operational overlap. That means no messy, complicated integration. The CEO even told employees the move should feel like a non-event for them internally. And this wasn't some kind of rescue mission, not at all. Guild was performing incredibly well on its own. In the third quarter of 2025, right before the deal closed, the company pulled in a net revenue of over $307 million. This was a healthy, thriving company, joining forces from a position of real strength. And again, the CEO's own words confirm this. Terry Schmidt highlighted the solid performance and continued positive momentum in that quarter. This deal was all about combining two successful operations to build something even more powerful for the future. Okay, so if we zoom out, what does all of this mean? This one deal perfectly highlights two massive trends that are shaping the entire industry right now. First, that ongoing consolidation among non-bank lenders trying to compete in a tough market. And second, the move of major players like Guild out of the public markets and into private hands. So, the crucial thing to take away from all this is that the story of Guild and Bayview isn't just an isolated event. It's a huge signal. It's basically a blueprint for how companies are adapting to a new economic reality, building these more resilient, integrated models to weather the storm and get ready for whatever comes next. And all that leaves us with one final thought. As this trend of consolidation keeps going, with the big players getting bigger and integrating all their services under one roof, what does that ultimately mean for you, the consumer? What could it mean for the cost, the service, and the choices you have for your next mortgage? It's definitely something we're all going to be watching very, very closely.